Welcome to The Legal Broker. I'm your host, Bill Rosenblatt, a licensed attorney and real estate broker. Today we are going to discuss the Dodd-Frank Rollback and what this means to you. Before we start, the information presented here is not intended to be and should not be taken as legal advice. Laws vary significantly by jurisdiction, state, province, or country, and are constantly changing. What is discussed in a video may not apply to your specific legal situation. Now let's dive in. On March 13, 2026, President Trump signed an executive order directing every major financial regulator, the CFPB, the FHFA, the OCC, and the FDIC, to revisit the mortgage rules that have governed lending since the 2008 financial crisis. This is not a tweak. This is a philosophical reversal of how the federal government supervises home lending in America. But here's what most commentators are getting wrong. This executive order does not change a single law, not one. It is a directive, a command from the president to his regulators to begin the process of change. And that distinction matters enormously for your money and your rights. To understand where we are going, you need to understand where we have been. After the 2008 crash, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Among dozens of provisions, it created the Consumer Financial Protection Bureau and imposed strict new rules on who could get a mortgage, how that mortgage had to be documented, and what happened to lenders who got it wrong. Those rules were designed to prevent predatory lending, and by many measures, they worked. Default rates dropped. Predatory products largely disappeared. But there was a cost, and that cost fell hardest on small lenders and the borrowers they serve. This hardship is illustrated best by the astronomical reduction in mortgage lending by community banks. Since Dodd-Frank has taken full effect, community banks have seen a 71% drop in mortgage lending. One reason for such a decline is that the compliance costs associated with Dodd-Frank exceed the profit margin. The federal government essentially disincentivized community banks from lending to its community. Now we have a basic understanding of Dodd-Frank. Let me walk you through what this executive order directs, section by section, because the details matter far more than the headlines. First, the order tells the CFPB to expand the qualified mortgage safe harbor for portfolio loans. Right now, if a bank makes a mortgage and keeps it on its own books, does not sell it to Fannie Mae or Freddie Mac, it still has to meet the same documentation and underwriting thresholds as a loan destined for the secondary market. The argument is straightforward. If a bank is keeping the risk, why should the federal government dictate the exact paperwork format? The bank has every incentive to underwrite carefully because it eats the loss if the borrower defaults. Second, the order targets the Truth in Lending and Real Estate Settlement Procedures Act integrated disclosure rules. Right now, if a lender misses a disclosure deadline by even one day, the entire loan can face legal challenge, regardless of whether the borrower was actually harmed. This is a significant philosophical shift. Moving from a process-based standard to a harm-based standard changes the entire enforcement posture. Third, the order pushes for expanded use of alternative appraisal models, automated valuation models, desktop appraisals, and hybrid approaches, particularly for low-risk transactions. For a first-time buyer stretching to close, $500 to $800 for an appraisal is real money. If the property and the borrower profile are low risk, the order argues that a less expensive valuation method should be permissible. Fourth, the order directs the CFPB to raise the asset thresholds for Home Mortgage Disclosure Act exemptions and to streamline the data points that must be reported. Over 110 data fields per loan. For a community bank making 50 mortgages a year, the data infrastructure loan can cost more than the revenue those loans generate. And fifth, this may be the most consequential piece. The order directs regulators to adopt a correction-first enforcement philosophy. Under the current framework, a bank that makes a good faith paperwork error can face the same enforcement posture as a bank engaged in systematic fraud. The order says regulators should distinguish between those two scenarios. The clear winners are community banks and credit unions. If these rules are loosened, smaller lenders can re-enter the mortgage market without the compliance overhead that has been driving them out for nearly 2 decades. Do watch the rulemaking calendar. When the CFPB publishes its first proposed rule under this directive, that is when the real action starts. If you are an investor, pay attention to community bank stocks and small lender valuations. If these rules are implemented as directed, smaller lenders will see margin expansion. If you are a real estate professional, get educated on the rulemaking process. Your clients are going to ask you about this, and the worst answer is repeating a headline without understanding the legal mechanics underneath. This executive order is the opening shot in a multi-year process to reshape American mortgage regulation. It is significant, it is consequential, and it is, as of today, entirely aspirational. Not a single rule has changed, but the direction is unmistakable. I will be covering every stage of this rulemaking process as it develops. If you want to understand the legal mechanics driving the biggest financial decision most Americans will ever make, subscribe to this channel and turn on notifications. I am Bill Rosenblatt, attorney, broker, and your legal lens on real estate. I will see you in the next one.